Good day, fellow investors. In a recent interview, David Einhorn said how there is value with agriculture, which is cheap compared to the cycle, and there is an opportunity, and he shared CNH, the company that makes the combines and the tractors and some construction equipment. And my job is to look at companies, summarize the risk and reward so that you can make a financial decision. That's what I do professionally on my research platform, have been doing for more than a decade, and thanks to all your feedback here on YouTube, I think I'm doing it well. If you enjoyed the analysis, smash that like button. And let's look at the business that David Einhorn is saying it is a buy. So we have agricultural products, tractors, combines, autonomy, not autonomy, alternative propulsion. So something that we are going to use no matter what, because I think that we need to eat tomorrow. And that's exactly the trends that are positive. And you always want to invest with positive structural trends behind your investment. So we will need to feed 10 billion people by 2050. That's likely more industry, more machinery. There are scarcity of resources, labor shortages. The farmers need the technology to increase the productivity and improving sustainability, of course. And then there are always supply chain issues that can trick you. And if you look at things, again, from a food price index, we had low food prices, a relative boom, but for now food prices have stabilized at a much higher level. That was the case in the 2010s. That's exactly how food works. It works in cycles, and then over time it goes higher. And if we look at the companies' earnings per share, positive cycle, then 2015-16 was bad, positive, COVID, no sales, but now we have had that boom, which is a positive cycle up to 2023. Unfortunately, the cycle, as always, reverts, and now we have a decline of 22% of revenues already, net income down 43%, but there is still net income. Earnings per share also significantly down across the cycles, and that's what's going on with the business. Declining retail demand, because as food prices go down, farmers don't rush to buy new equipment, so they will lower production levels to address demand weakness, limited progress on dealer inventory reductions, and they have to focus on that quality. What happens when farmers don't buy new equipment for a few years? That's exactly the cycle. Food prices are low, less new equipment, less investments, less this. Everyone is sitting tight and waiting. Sales are much lower, nobody makes any money. But 3 years pass, and then you have the need to reinvest. Food prices first shoot up, farmers run to the company, buy new equipment to gain on that different margin of food production, food prices, and that's clearly the food cycle. At the end, you always eat the same, maybe a little too much, as I do. And now, yes, we are in a downturn, so everything is down, everything looks ugly. If we look at the financials, it is down, delinquencies on their finance portfolio are a little bit up, so things are not looking great, but they will just keep on doing their thing, focusing on growth for the next cycle, keeping a healthy balance sheet, maintain a dedicated and consistent dividend and share repurchase policy. We'll discuss later how they nailed it, and then perhaps if there is an opportunity, they can do some M&A. The outlook, if you look at what's going on, it's pretty bad for 2024. 2025 doesn't look much better, and that leads also to the guidance much lower. Free cash flows will actually be negative for the year, and the current earnings per share went from 1.7 at the peak of the cycle to around 1. But we did this video from Peter Lynch categorizing stock market investments, which is one of my most important videos. I'll put the link in the description below and here. In that video, we discussed cyclicals and how to invest in cyclicals. We have automotive, airlines, tire companies, steel, chemical, travel, food, inclusive in cyclicals. And when it comes to investing, They flourish when the cycle is good, when food prices are high. When food prices are low, they suffer. 50% drops are normal if you buy at the wrong part of the cycle. You can wait for years before seeing another upswing. 2 to 5 years in the food industry. Large and well-known companies make the unwary stock picker most easily part with his money. Think of Deere, like good brand. Timing is everything, so you need to watch the inventories, and for new market entrants, stock usually decline when peak earnings is reached, as we have seen now, and you need to know your cyclical to know the food cycle. Easier to predict an upturn than a downturn in the industry. That's Peter Lynch. Enjoy that video, it is key. And we are now looking at reductions, so still looking bad, likely inventory piling up, and that's something we need to watch. Food prices, you might already buy it because David Einhorn says it's cheap, and when you look at things, 2023 that was good, they did great repurchases, they really bought here when the stock was cheap, and they are still paying a good dividend. Now Einhorn marketed it, the stock is a little bit higher, but still, price of $12 compared to the potential earnings of 1.7, maybe 2 in the next cycle, that's a P ratio of 5, that's a 2x on the stock price when the cycle reverts. They did some good repurchases, as I said, which is uncommon for Wall Street to really nail the bottom with repurchases. Wall Street usually buys at the top with repurchases, but this is what we have now. I cannot tell you how long the cycle will last, but remember, food prices were low, then of course COVID, food prices up, but food prices have stabilized at a new level, and likely the next cycle it will go higher. When we put this into our value investing quadrant, I have put it here. It has a 10% likely yield over the cycle. The risk, I just might not know it enough to put it higher, or I just can't see that upturn yet because it might lag food prices going higher, and therefore I'm putting it here just for precaution. I have already some interesting covered stocks in the food that I think have a little bit lower risk than production of tractors and combines, because they have some competitive advantages and I know the sectors better. Food cycle, food exposure, so I'm just personally not looking for more, but if you're looking for something that will likely give you 10% or more over the cycle, that will not lose you money over the next 5 to 10 years, this is a great play shared to us by David Einhorn. If the price goes significantly lower, I don't know, below 10, I'm sure in the comments you will notify me, and then we can look at again where we are in the cycle and how it could be a better buy. If you go buy into now, always have the room for another buy lower, because as Peter Lynch said, you cannot predict food prices and food cycles, but you can easier predict the upturn. So if you have a strategy, it is something that we will need in the future, and therefore it has a margin of safety, a good yield over the cycle, and therefore a very interesting stocks to put on your watch list.